Now we get to pivot to Europe a bit, and there's a lot of things happening in Europe, and we just want to touch on, European economies and how they fared versus what was expected. So we did get some better numbers than expected. So the contraction or the double dip wasn't as extreme as initially people thought it was going to be initially. So now the question is, how much of that is actually just pushed into Q1 versus being realized in Q4, as we have a continued problem on the services side. So manufacturing has been fairly stable, if not better than expected, throughout parts of Asia, throughout parts of Europe. But we continue to see services struggling, and that struggle is surprising further to the downside. So we've also seen the consumer slow a bit versus 2020 into 2021. We also have CPI, which has increased from 2020 to 2021. So we think that some of the pain that was expected in Q4 is actually going to be realized in Q1. Now, it doesn't mean that, it just means that expectations are too high for Q1 and for what, as we've been saying, for what 2021 expectations are. Now, let's just take an example, and let's use Germany for one, given the fact that they came in a bit better than expected. So let's look at just some of the high frequency data points. So let's take new cases. So new cases continue to remain elevated. They're still at levels that they want to be below if we consider where they were on October 9th. So they've talked about not loosening up restrictions until they're back to where they were as in October and really the beginning of October. So that, if you can see here, is about 14,700. Right now, as of the middle of January, they were at 117,000, and based on what we showed in the EIA show, they're still at about that level. So they're not seeing that reduction. So what is that causing? Well, the lockdown index, which really didn't start till December 18th, going from that 67 to 82. So again, when you think about Q4, you had a December uplift that really didn't take effect until January, and then the stringency index, or the lockdown index, actually increased from December into January, going from 82.4 to 85.2. So again, the impacts that maybe should have been or were expected in Q4 are now bleeding into Q1. Now let's look at job postings are fairly flattish, which is a positive. Public transport use is not doing all too much. Traffic congestion still remains depressed, but flight departures, restaurant bookings, high street footfall, people are still doing less. So the activity indicators are still at this, negative 37, negative 45 level. So again, these are problems that are not going away tomorrow and are really going to impact Q1 to a greater degree than I think Q4 in general. So now let's take politics, because now we can look at what is happening in general as we shift to Italy. So Italy is an interesting one because he tried to create a new government and a new coalition. Now that failed again. So that failed. So now Draghi has been called in and tapped to try to save the government, and maybe it's time to have an election. Now, the Five Star Party, which makes up 92 seats in the Senate here, seats in general, that's a problem because they've all said they will not vote for Draghi. So, okay, now, does that mean that they can get other areas to back Draghi in order to try to find some sort of coalition that's going to work? Now, the market thinks Draghi coming in is a fantastic idea. Everything is up because, the father of bubbles is coming back into Europe in terms of just printing a significant amount. So obviously that is being seen as a positive for Italy and stimulus in general, even though the Italian debt is one of the worst in all of Europe. There's still a view that they need more stimulus. They've increased stimulus 32 billion euro. It just means that there will be more to come in general, as Italian data has remained weaker than most in the region, which we'll talk about in a few minutes. So when we look at, again, German willingness to buy versus German GDP household consumption, this is what we're talking about when we look at German data and look at, now that we're to briefly covered the political situation. So GDP household consumption, if you look at just the viewpoint of what people are willing to consume, that has shifted down. Again, you had the VAT tax come back in January. You had these adjustments. So GDP household consumption year over year, we, again, considering what's going to happen, is going to move lower, which, again, is going to put pressure on Q1 estimates. So then when we look at, okay, well, let's look at just Europe in general. What is happening with just general government deficits? So when we look at the local government level and you look at the central government level, you can see that the central government, just the extension of government deficits by billions of euro continues to widen out. So now you have Draghi coming in, or potentially coming in, to help out Italy. So Italy already has, let's call it 133% of GDP in debt. They're now going to print more, and you have tourism struggling, you have industrial struggling, you have services struggling, you have inherent activity on a local level, on a tourist level, and just based on where the euro is right now, where the euro still remains rich to the dollar, which means that your exports will be more expensive to purchase. Well, how are you going to weaken the euro to try to essentially strengthen your exports? And if you look at, coming back to Milton Friedman and one of his pushbacks on the euro, if you can't weaken your currency, then it's going to be hard to stimulate the economy on the import side. So if Italy still had its own currency, you would have the ability to see, okay, well, the economy's struggling, so you're going to start to put pressure on that currency. You're going to have concerns on it. So then that currency will get weaker. And let's just take the dollar for an example. The dollar will get stronger, and you would be more apt to purchase from Italy than elsewhere. And someone who might like, leather or fine goods, that would be exciting. You get to buy Italian products at a cheaper price. You lose that when you have the euro that's essentially priced off of Germany. And again, you're missing that GDP growth, because instead of seeing the GDP growth going up, Italian GDP has essentially been flat with minimal growth since joining the euro in general. So again, there's coming to full summary. Now, given that's oversimplified, there are a lot of caveats within that, but there's just something to consider when you're thinking about euro and the dollar, and why Lagarde wants to try to weaken the euro, why Italy coming in and trying to stimulate more could be an inherent problem. But that means the ECB is going to have to buy more debt. If the ECB buys more debt, you become more of like the Japan and the Japanification, as we continue to say. And these are problems and issues that we continue to see, happening in the system in general. So then when we look at, again, looking at just estimates on euro area consumption basket. So let's look at what their consumption is. Again, food continuing to go up in 2021. When you look at housing, when you look at transport coming down as people are doing less, again, coming to services versus other, those are issues that we continue to see in the market. That is a bigger problem in general. So that's why when we look at things overall, as we go through restaurants and hotels, education, so education is fairly stable. It's the biggest issue, and you can say this in the US as well, food and housing remains the overarching problem in terms of where some of this inflation is, especially on the food side. So now, when we look to Eurozone, just data points. So let's take the Eurozone in general. So consumer confidence is essentially flattish for January. Economic confidence ticked up a little bit as we had some more support. Industrial confidence, again, ticked up a little bit again. Service confidence, that again, all moving in the right direction. Still negative, but again, moving in the right direction. Market Eurozone manufacturing, essentially in line. Unemployment rate in line. GDP slightly better. And again, that's looking at things being slightly better. But when we turn to January, February, That's where we continue to see some of those pressures. That's where we continue to see some of the issues that are reverberating through the system that will start to show up in that consumer confidence side as the consumer does less within the Eurozone in general. So now let's pick out France. So consumer spending was missed estimates slightly month over month, slightly better year over year. GDP came in better than expected. But when we look at France manufacturing, again, we're expansionary, but just slightly expansionary, which is why we continue to struggle to see how they're going to get out of this movement, especially because France, out of all of the countries, has done better than most, especially Italy, especially some of these other regions where France has, Germany on the manufacturing side has also done well, but services continue to be a problem in general. So let's look at Germany. So import price index continues to be negative. When we look at unemployment changes, slightly better. GDP, again, coming in slightly positive. But when we look at retail sales month over month, expected to be down 2%, was down 9.6%. Retail sales year over year was expected to be up 4.7%, was down 1.5%. Again, these are things that remain a problem, especially when we consider where things are on the retail side. Now let's look at manufacturing in general. So, and I'm just going to pull up what the services side was, because I forgot to just pull in that number as well. So now let's look at, and now that I have it all, so let's look at German services. So let's take Spain. So Spain came in at, so expectations were for 45, came in at 41. Composite for Spain was supposed to be at 46, came in at 43. Italy services was supposed to be at 39.5, came in at 44.7. Italy composite was supposed to be 43, came in at 47. So that's a positive side. France was supposed to be 46.5, came in at 47. And then when we look at Germany, so Germany was slightly worse, where it was supposed to be at 46.8, came in at 46.7. Eurozone in general was a slight surprise to the upside on 45.4 and 47.8. So still contractionary, but again, this is where we keep talking about that stabilization where things are flatlining in general, not really getting this movement to the upside, especially as we have the consumer slowing down and some of these pricing indexes getting a bit worse. So then when we look at shipping bottlenecks disrupting the supply chain, this is what we've been talking about when we not only are we seeing that service side, again, driving some of that PMI, driving some of those service delays. This is just a percentage going back to 1997 on the percent of manufacturers reporting delays related to ports, shipping, you obviously have British exit. You have issues at the ports in general. So this is a very big number that is not going away anytime soon. It'll normalize lower, but again, we're not going back to these lower levels that we've seen in previous years. And when we look at China, Europe freight, China, East Asia to North Europe, here you can see just the inherent costs going up. Again, this is going to get pushed through to the consumer. Again, coming back to the impacts on income, the impacts on unemployment, the impacts on inflation. This is where we continue to see some of this pain. It's normalized a bit, but this is going to continue, again, going to pressure some of those GDP numbers, especially as you have prices going up, people doing less, again, things that are going to be that inherent pressure overall. Now let's look at manufacturing purchase managers index. So the shipping shortfalls, this is where we continue to see those shipping supplier delivery time lengths. So even though some of the data looks better, a lot of it is also being driven by what's driving some in the U.S. So now, in the U.S., we're at least very positive, 58. So when we back out some of these delays, we're still in expansionary territory. Now, some of this is just below 50 or just above 50. So once we take out some of these shipping shortages, they're still in a contractionary mode, which again is going to lead to more problems when we think about the future of what Q1 is going to look like and how is that going to be positioned, especially with vaccine rollouts being fairly slow, trying to catch up. But again, these are some of those pressure points that are being pushed that are going to be a bigger problem within Europe. So now let's shift a bit to emerging markets, because we're also seeing pandemic stimulus in other areas, and we're seeing the indebtedness in Brazil, Mexico, Latin America in general going a little bit higher. Now, Brazil is now over 100%. Now, this is a country that has had issues with hyperinflation before. There are going to be some underlying problems that will really get pushed through the remainder of the area, and just, again, leading to some of those raw materials going to other areas. Just looking at emerging markets, not just Europe, but also where are the emerging markets and how are they going to move and try to stimulate their economies as well. Now, when we look at, inflation is rising rapidly in Brazil due to those temporary shocks. Now, what are the temporary shocks? And we've talked about them. Everybody's experiencing the same types of shocks. Now, the problem with Brazil is they are very slow to plant because of weather, because of COVID, because of a lot of issues that won't be going away anytime soon. Chile is experiencing something to a lesser extent, just as we have copper production year over year was actually down 8.7%. So when we look at raw materials in general, we talk about China, we talk about these areas with coal, iron ore, copper, all of these things are costing more because we have supply disruptions. It's not, obviously there is a certain amount of demand, but there is also a supply problem, which we have still not worked through given the issues from COVID, which has pushed up a lot of these commodity prices, which is just not going to go away anytime soon. And that's why we continue to see some of these shifting movements and these momentums, which we'll talk about in a bit more detail in the next segment and try to layer in why this emerging market stress is going to put more pressure on other areas, especially China and Asian nations that import a lot of raw materials, as we continue to see those prices go higher, as we showed earlier on why that impacts U.S. pricing as U.S. imports a significant amount from China. And prices paid in China are going to go up, and that's going to get passed through to the consumer. And again, how it pushes through the system is going to lead to higher inflation, not just in the U.S., but also Europe. And again, as they try to stimulate their economies using debt, as pain continues to sit through the system, even though the market continues to push to all-time highs. So in the next segment, we're going to look at Asia in a bit more detail, especially the geopolitical side and what we're seeing and how there are some bright spots specifically in Asia at the current moment, depending on where you're looking, specifically South Korea, Taiwan, and Vietnam.